Hey gang, you're with the broker, Rich Lane. Summer of 2020, we're getting near the end of summer. Again, we're here with KP, partner PRMG, as we're honored to be here with you, talking about some stuff going on in the mortgage markets. We got a lot going on this week, KP. Listen, I'm an originator. I'm a street level guy. I'm floating 10 units. And then I get this email on last Thursday. We're going to get hit with 50 bips of LLPA. How do I handle that with my borrowers? Let me know. What's going on?
Yeah, no, it's good topic of conversation. First of all, for those in Northern California facing there's 4 different wildfires out there, we're thinking about you, and hopefully you can manage through that. This California, this heat wave is crazy. This is like one of the rare times you'll ever see me in shorts. So it's been hot in California. So hopefully everyone up there is doing okay. The 50 basis point adverse market fee. It's actually technically not a loan level pricing adjustment. I wish it was, because then we would be able to say, hey, borrower, you can't do a 95% cash out. LTV cash out. That's why it's the risk that's there. No, this is a sudden, instant 50 basis point fee that the government-sponsored entities, Fannie Mae and Freddie Mac, who are overseen by the FHFA, which is, the regulator after Dodd-Frank was passed, and Dr. Mark Calabria, the director, they have decided to pass this. And what's interesting is, it's been about a week, and so we're having real conversations with borrowers. I mean, Rich, you're having real conversations with borrowers. There's a guy, Andy Harris. He has a loan that's with us right now, and his client was negotiating for a 2.5% 30-year fixed rate, and Andy and his team were willing to go, do what it takes to get that rate down and all that. And then, this negotiation has been ongoing for about a week. And then rates started creeping up at the end of last week. We had about a 50, 52, 55 basis point 10-year. And, we got up to about 70, which that kind of generally runs in concert with rates. So interest rates on the mortgage side went up. Then this 50 basis point hit. Bad timing. I don't know if they tried to time the market at Fannie, Freddie, and FHFA, but rates went up when it was at an all-time low. And so I'm dealing with one of our clients in the broker side, with Andy and his client. We're already negotiating a rock bottom rate, plus now there's this 50 basis point hit. So there are real problems with real loans that are in process that are all being changed because the way this was delivered, instant, no discussion, just one page, like, hey, we're doing it. And so I know you're dealing with it. We need to tell how borrowers, the taxpayers, are not happy with this. This isn't just a bunch of lenders whining and originators talking about it when we're all very busy and working very hard. Borrowers are affected by this, and they're not happy either.
Yeah, I totally agree. And on the street level, as an originator, my borrowers do not care about the industry jargon. They don't care about the LLPA. They don't care about any of that. They care about rate, execution, and fee, and they want me to deliver. So I get that, and I just have to have a really transparent conversation with them about, hey, look, here's where we're going, and you have a great rate, and we're probably going to float you and get you an even better rate, but there is definitely, it's a risk situation, but if the risk blows out, you're still in a pretty good position.
Yeah, no, I agree. I mean, it's if typically when there are changes that are this impactful, a 50 basis point adverse market fee because of economic uncertainty, this is twice as much as the 25 basis point adverse market fee that lasted 4 years, by the way, after the Great Recession of 2008, which I think most would agree that this recession, I know, there's still, more uncertainty ahead. I agree with that. But generally, this is not even remotely on the level of severity as the 2008 Great Recession. And the housing industry is actually the one industry that's pulling our economy out of it, among tech and other things, but that's just a few wealthy, individuals there. But housing is for Main Street. Housing industry and mortgage and finance and real estate is to put people in the single largest asset payment they make in their life, the single biggest purchase they make in their life, and we just tax that or hit them with a fee. And so, just explain what is the uncertainty. So if I can, let me defend in a contrarian way. Let me defend for a second the decision to do that. Not the way it was delivered, not the messaging, not the instant effect and impact, but why it's there. The FHFA sat back and watched all the people claiming forbearance after the CARES Act, and a lot of people are saying, look, we're going to have to pay for all these borrowers not making their payments because, rightfully so, they have a true hardship. Even though the CARES Act didn't put a mandate for them to document the hardship, you could just simply say, hey, COVID-19, hardship? Yep, hardship. All right, 12 months free. Have a nice day. So the lenders have to pay for that. Dr. Mark Calabria and the FHFA and Fannie and Freddie, they stepped up and they said that they would pay for Fannie and Freddie conforming loans payments 5 through 12. The principal and interest, not the taxes and insurance, but the principal and interest. That is a lot of money. And if that is the main driver of the adverse uncertainty market conditions that the 50 basis points is to pay for, then let's do some math. Let's put some modeling down. We need X amount of money. You want to put a cushion? Fine, tell us the cushion. This is what it's paying for. This is how much it's going to cost. And, we're good at math in this business. I mean, some of us took calculus in high school. Those who saw Rick Suklis out there, he had his HP calculator, doing the payment stuff on LinkedIn for our LinkedIn community here. We're good at math in this business. And so, let's do some math. Let's see how much money you need. Let's model it out. But we're not given that. We're not giving a heads up. We're not being given education. There's no communication. There's no dialogue. I mean, look, if you want to be heavy-handed like the IRS and just say it's what it is, just realize there are unintended consequences. And then going forward beyond this move, are we just going to take it? I mean, do we have a choice? This is a government-sponsored entity and a regulator imposing a fee that has real economic impact on taxpayers and people who are working in an industry that's trying to pull this economy out of it. So can they do it again? Are they going to do it next month? Is it going to be another quarter? Is it going to be a 75 basis point fee for cash outs? Is there going to be when non-QM comes back? Are there going to be ramifications for that? Are there changes for other regulation in the future that we don't get to be a part of? It just doesn't pass the smell test.
Listen, Matt Ishbia, CEO of UWM, he always comes out every week with like a video, 3 points. I'm going to make 3 points to you right now. Number one, don't ever wear shorts in my video of mine ever again, okay? Oh my God. Number two, calculus, you obviously did very well. They wouldn't even let me in the front door. Number three, and then we're out of here. Internally, I think you're a very beautiful man, okay? All right, listen. Hey, everybody. Rich Lane, the broker. You're with KP, the partner, and we're out. Thank you so much.
Cheers.